How can a business actually make its owners richer by taking on more debt? Think of a company's capital structure as a pizza, baked using equity, the owner's money, and debt, borrowed money. The proportion of that pizza made up of debt slices is financial leverage. Using a high amount of debt means the company is highly geared. This diagram illustrates exactly how that mechanism works. The blue triangle at the bottom represents your fixed cost funds, like loans. This acts as a fulcrum. If positioned correctly, you can use that fixed debt as a lever to push your overall earnings upward. This balancing act is known as trading on equity. The fixed interest from a loan acts as a mechanical lever that will either multiply the owner's returns or, if earnings drop, severely crush them. Here's the mathematical rule of leverage. If your business generates a higher percentage return on its investments than the interest rate you pay the bank, your shareholders pocket the difference. This table proves the math. We have a company needing 30 lakh rupees in total funds, currently earning an EBIT of 400,000. We are testing 3 structures: Case 1 with 0 debt, Case 2 with 10 lakhs of debt at 10% interest, and Case 3 pushing that debt to 15 lakhs. When calculating this, the order of deductions is strict. We start with the earning before interest and tax. First, we subtract the interest payments to get earning before tax. Only then do we subtract the 50% tax rate to find the final profit. Look at the resulting bottom row. Even though the company takes on more debt and pays higher interest in Case 3, the earnings per share climbs steadily from 6.67 to 7.5 and peaks at 8.33. Because the return on investment was strong, adding fixed debt directly made the equity shareholders wealthier. This is known as favorable financial leverage. Let's test the inverse. Pause the video and calculate what happens if the return on investment drops to just 6%, but the bank still charges 10% interest on a 50 lakh total capital setup. Welcome back. This table lays out the new reality. Starting with a smaller 3 lakh EBIT, we subtract the required fixed interest across the 3 situations, leaving a much smaller earning before tax. Then we deduct the 30% tax. Review the final earnings per share on the bottom row. Under these conditions, adding more debt causes the earnings per share to actually fall, from 0.42 down to 0.35, and finally to a low of 0.23. When the return on investment is less than the interest rate, the borrowed money costs more than it produces. Trading on equity becomes unfavorable and actively destroys the owner's wealth. Real companies run this exact math to structure their capital, weighing several practical risk factors. The most immediate is cash flow. A business must generate enough reliable cash to cover those mandatory interest payments. Otherwise, it cannot safely handle debt. To measure this, companies use the interest coverage ratio, dividing EBIT by interest. They also rely on the debt service coverage ratio, a stricter metric that includes both interest payments and the repayment of the loan principal. Another major factor is the tax shield. Because a business deducts interest payments from its earnings before calculating taxes, borrowing money legally reduces the total income tax the company owes the government. Evaluating variables like the cost of debt, the cost of equity, and initial flotation costs requires balancing the mathematical rewards of leverage against the risk of bankruptcy. The entire logic of leverage hinges on the specific gap between ROI and the cost of debt. When ROI exceeds the interest rate, debt adds value for the owner. When ROI is lower, the same debt destroys that value. To review, capital structure is your total mix of debt and equity. Financial leverage measures the precise proportion of that debt, and trading on equity is the deliberate strategy of using fixed-cost loans to amplify shareholder returns. You now know how to mathematically prove the effects of leverage. If this breakdown helped you master the concept, hit the like button, subscribe for more step-by-step business guides, and keep studying.